According to a recent Morgan Stanley report, inflation will fall to 2.4% by the end of 2023. Rate hikes will cease, and the economy will flatten but not shrink. Choosing the right stocks for 2023 during uncertainty is difficult. Most investors should be cautious at this time, and this typically involves preferring mature, stable companies over smaller, more agile investments. It may also imply settling for less growth potential. Therefore, in this video, I'll share my top 3 overlooked stocks for 2023. At number 3, we have Amazon. Amazon is the world's largest provider of cloud computing. The Amazon Web Services platform outperforms Microsoft's Azure and Alphabet's Google Cloud. Amazon has had a difficult year in 2022. By the end of the third quarter, the company had lost approximately $8 billion on its global e-commerce business. Although the high-margin AWS segment is profitable, growth slowed in the third quarter and fell short of analysts' expectations. In addition, the company announced plans to lay off up to about 20,000 workers in distribution centers, IT departments, and executive positions. Amazon's stock price has dropped by roughly 50% since January 1st. That is bad news. The good news is that a difficult 2022 positions Amazon for a stronger 2023. For one thing, profit comparisons will be simpler. More importantly, CEO Andy Jassy is working to reduce the company's cost structure. Amazon invests heavily in non-profitable areas, such as its international and devices divisions. The emphasis on efficiency should result in strategic changes in those areas, as well as cost-cutting in ongoing activities such as package delivery. For the first time since 2012, Amazon also repurchased billions of dollars in common stock in 2022. The company's share repurchase authorization is still $6 billion. Continued share repurchases would support higher earnings per share in the future. On top of that, Amazon's stock price appears to be low in comparison to its history. Amazon's consensus price target is around $140, and the stock is currently trading below $90. Number 2 on the list is Dollar General. Dollar General is a well-known discount store chain that sells consumer staples at low prices in convenient neighborhood locations. The company sells its own private branded products as well as popular brands such as Clorox, Procter & Gamble, Coca-Cola, Kellogg's, General Mills, and others. There are over 18,000 Dollar General locations in 47 states. Dollar General stock is up 3% in 2022, even though the S&P 500 is down nearly 20%. This year, the chain has seen an increase in foot traffic as well as an increase in the amount of money spent per transaction. However, Dollar General is feeling the effects of rising costs. As a result, business leaders are focusing on streamlining their supply chain. These efficiency efforts will not only help with the current inflation trend, but will also provide long-term benefits. Meanwhile, Dollar General is expanding to support revenue growth. The 11.1% increase in revenue in the third quarter of 2022 was due to new store openings, plus a 6.8% increase in same-store stores, which was partially offset by store closures. Despite some gross margin pressures due to higher product costs, net income increased by 8% in the third quarter. Dollar General actively returns value to shareholders by repurchasing shares and paying dividends. Share repurchases totaled 2.3 million shares in the third quarter, and the company has $2.5 billion remaining on its share repurchase authorization. The dividend yield is around 0.9%, which isn't particularly high, but Dollar General's 3-year dividend growth rate is more than 13%. Dollar General benefits from difficult economic times. Even if the economy stagnates or worsens in 2023, the trends of increased traffic and higher average transactions are likely to continue. In addition, the company plans to open 1,050 stores by 2023, including 35 in Mexico. Dollar General's consensus price target is $265, up from its current price of around $248. Number 1 on the list is Walt Disney Company. Walt Disney Company is divided into 2 segments. Theme parks are operated by Disney Parks, experiences, and products all over the world. Disney Media and Entertainment Distribution owns and operates television networks, film studios, produces and distributes television content, and operates direct-to-consumer streaming networks such as Disney+, ESPN+, Hulu, and others. Disney also licenses third-party trade names and characters for use on merchandise and games. Disney stock has dropped roughly 45% since January 2022. The entertainment company's streaming business has been losing money and not generating enough cash to meaningfully reduce its debt load. Dividends and share buybacks are also off the table for the time being. Despite the leadership crisis and disappointing earnings, Disney has some bright spots. Its streaming business has seen rapid subscriber growth. In its most recent fiscal year, the company added 57 million subscribers. This brings the total subscriber base to 235 million, surpassing Netflix. Disney also recently launched Disney Plus Basic, a low-cost ad-supported subscription service. Theme park revenues are increasing following the COVID-19 shutdown, which helps the bottom line. In fiscal year 2022, the theme park business generated less revenue but higher operating income than the media business. Expect Disney to continue growing in its streaming revenue in the coming quarters, but with a greater emphasis on profitability. Chapek predicted Disney Plus would be profitable in the fiscal year 2024 in his most recent earnings release. Iger oversaw the launch of Disney Plus in 2019 and is unlikely to miss Chapek's forecast. The combination of Disney's low stock price, recovering theme park revenues, a stronghold in streaming, and a respected CEO at the helm adds up to a good 2023 buying opportunity. Disney's consensus price target is $124.05. The stock price is currently trading around $85. The year 2023 will undoubtedly bring some economic and financial market surprises. Fortunately, there is a strategy that can protect you against unexpected stock market drops. Purchase good companies and be prepared to hold them for a long time. If the economy does a stall next year, good companies should recover at some point. Wait for that recovery, and any price declines in the interim will be rendered largely insignificant. On the other hand, if you become impatient and sell when share prices are falling, you unnecessarily lock in losses. So, whatever 2023 brings, stay the course. That is the most difficult aspect of investing, but it is also the most certain way to increase your wealth. If you're interested in this topic and want to see more, then make sure to click the video you see on your screen to see my predictions for the stock market next year.